Hello, this is Daniel Want from Prerequisite Capital Management. Today we're going to briefly provide a quick summary of our latest Australian property and rates monitor. Obviously this is general information only and should not be considered specific advice. So the purpose of this publication is basically to survey some of our more unconventional models pertaining to the Australian property market and also the banking system. A lot of these models obviously are leading in nature, and also we tend to pay a lot of attention to how different participants around the different sectors of the economy are actually positioning relative to the housing market. There are different participants that have different access or different levels of access to information, different balance sheets, different incentives, and so looking at what they are doing at different points in the cycle can often be quite instructive as to what is actually going on in the property market, in the banking system, and therefore it tends to give rise to some confirming sort of views as to what is likely to happen in the years to come with regards to Australian property. So I won't go into detail around this report, but obviously we cover a lot of the main elements that influence Australian property markets. The takeaway conclusions, however, are fairly plain. So back on the 9th of May, and we provide further history of some of our property-related publications going back to 2018 in Appendix 2 of this report. But anyway, back in the middle of 2021, our primary conclusion was that the rate of growth in property credit and prices was likely to peak over the next few months and begin to decelerate. Obviously, we can see that that's precisely what happened. Credit obviously tends to lead property prices by anywhere from 3 to 9 months, depending on what is going on in the cycle. And so that decelerating rate of growth has largely been intact, and especially in some of our updated property reports, we've largely maintained that trajectory in terms of the conclusions. However, recently, it's becoming increasingly clear. So on the 4th of May, we identified that in 2023, it's highly probable that international capital flows might be started to be attracted back into Australia, and this could provide a bit of a buoyancy to the deceleration that we've been seeing in Australian property conditions. And so now that we've updated a lot of the analysis metrics, which we might go through some of the high-level summary elements, the conclusion is that it is highly probable that this negative rate of growth, particularly in property credit, is likely to bottom in that deceleration somewhere around the second half of 2023, to the degree that leading indicators are any guide. So if property-related credit, the rate of growth bottoms around the second half of 2023 roughly, then that probably means Australian property prices will be starting to bottom, at the end of 23, maybe early 2024. Obviously, we need to take these forward-looking indications with a bit of a grain of salt, but at least it gives us a bit of a framework of expectations to be able to assess how events are unfolding. Obviously, the only qualification to that is that we don't experience any sort of internationally sourced negative shocks to the system. But so far, it looks like this is a fairly normal slowdown in property-related credit and also property prices. Obviously, the whole purpose of this document is to monitor these leading and coincident data sets of the system that are underpinning the Australian property market and the banking system in particular. So if any data starts to change between now and the latter half of 2023, will definitely provide an update on that. But at the moment, looks like the bottom of this negative or of this slowdown is likely to be the back end of next year. So just to provide some quick snapshots of some interesting charts. So this is our global economic leading growth impulse. It tends to surprisingly both mirror and even front run Australian property credit growth. At the moment, it looks like it's in the process of bottoming in terms of that global impulse. And so that would suggest, with a bit of a lag, that maybe, around 2023 might be that area where the slowdown in the rate of growth of Australian property credit might actually bottom. Looking at a few other unrelated methodologies, once again, here's the annual rate of change of aggregated property-related credit in Australia. And interestingly, one of our higher frequency leading economic or leading employment related impulses, tends to lead quite well, even though it's advanced in time by about 6 months, the actual rate of change of aggregated property credit. And it would suggest that we're starting to come into conditions that might be more constructive for the rate of change of property credit in Australia coming into 2023. So we have a few different methodologies that are pointing towards leading indicator type conditions becoming somewhat constructive at the back end of next year. Now, with regards to inflations, one of our primary Australian capital markets implied inflation expectations model tends to kind of sometimes front run but coincide property prices quite well. It definitely tends to front run our headline CPI statistics. Most recently, we've been seeing this deterioration in market implied inflation expectations according to this long run model. The last time we saw a divergence between the headline CPI statistic and what this model implied was back in 2008, where we saw the model basically deteriorating quite substantially, whereas the CPI numbers were sort of heading much higher, but at the same time having property prices starting to be dragged down and slowing down in its growth rate. And so we're kind of seeing property prices slowing down and confirming these pricing conditions in broader capital markets in the Australian system. And if 2008 is any guide, then we probably are seeing, peaking type conditions in our headline CPI inflation rates as well. And so we wouldn't really be expecting, property prices to sort of bottom or start resurging until we saw this sort of a model starting to pick up again. So this is an interesting model in that it takes the big four banks in Australia, the underlying movement of liquidity underneath their ASX traded securities, and overlays it with the total aggregated finance commitments for Australian property markets. And you can basically see that it's more like a real-time barometer of where property financing conditions are kind of at. At the moment, we're not sure whether this is quite bottoming yet. However, we are identifying that the patient money behaviour underneath the Australian big four banks, even though share prices under those securities could go a little lower, it seems like the larger end of town in terms of the institutional money management audiences are actually not far off and sort of marginally accumulating those stocks. And when we look at another bellwether of, say, the Australian property scene in terms of some of the securities or stocks that are listed on the ASX, we can see that REA Group is similarly starting to be accumulated fairly heavily by institutional sort of larger money. They're in a stressed or borderline stressed fundamental conditions in terms of the implied credit risk models or modeling that we maintain. And underlying liquidity for this security is exceedingly washed out. The last time that we saw this sort of a constellation where we had marginally stressed or increasingly stressed business conditions for this particular security in combination with patient money or larger money accumulation and a bit of a washout in liquidity was through the latter end of 2008. Now, this could still be a little bit early, but it's interesting that it's gaining such attention from the larger money crowd in Australia and even around the world. That would tend to suggest that this slowdown in property credit and property prices is likely to still be temporary. And so this would paint a picture that it is possible that we start to see a bit of a resurgence in property markets more generally, perhaps towards the end of next year. And if we, there's still no guarantees that these are the lows. We could still be putting in new lows. But if we start to see underlying liquidity really starting to shoot higher again, kind of like we see here and at the different points, coming out of these sideways sort of digestion periods, then that would be the final signal that perhaps this is a significant buying opportunity, even for stocks like REA Group. And that suggests that there may be some tailwinds coming back under Australian property prices, particularly, the end of next year. Looking at similar methodologies, except a little bit more focused around the Australian construction sector, when we look at an aggregation of, different securities relating to housing conditions and, construction-related activities in Australia, we can basically see that we are still decelerating, but we have a similar sort of picture where some of the larger money participants in Australia or around the Australian system are starting to accumulate at the margin securities in this space. And so that would tend to foreshadow that perhaps in a year or so, we might start to see a bit of a resurgence in terms of Australian property markets and construction and financing and all of this sort of thing. Still a little bit too early, but we're seeing a similar picture from a variety of different perspectives here. And that starts to give us a little bit more confidence as to what we might be seeing. Now, the capital flows section of this publication, is a little bit more in depth than usual, but if historic relationships are consistent, then that would suggest that perhaps around 2023 we see property prices in Australia start to bottom out and move back towards accelerating again. This particular model of stress in the world, which eventually, with a bit of a lagged effect, drives capital back into Australia, suggests that we see that bottoming out of property prices and credit growth in and around the 2023 sort of region, especially towards the latter end, with positive implications, as we push out in the next 2 to 3 years. So the capital flow perspective with regards to Australian property markets is that capital is likely to actually come back in a year or so, and that will be another tailwind to helping property prices gather pace again. And in a similar sort of manner, we can see immigration trends here in the royal blue, and some of our coincident and even leading models are for them to continue to accelerate into and around 2023. So that would suggest that this positive immigration trend back into Australia, especially after the lockdowns, is likely to continue to accelerate, and at the margin that would tend to be roughly supportive of Australian property market conditions after the sort of lull that we've experienced, particularly relating to COVID-related lockdowns or change of policy with regards to immigration. So as this price deceleration in property starts to moderate, there'll be plenty of sort of buoyancy provided from immigration trends at the margin. So this is one of our more interesting methodologies. It's our liquidity turning point framework that we developed actually for securities markets, but we're able to adapt for the Australian property market, particularly with regards to sort of the credit engine of Australia. And so whenever we get one of these sort of major or minor diamonds trigger, it's greater than a 70% probability that we're about to see a change of trend in the growth rate, or at least a change of structure in the momentum of that trend. And so some of the last time, we actually were able to start applying this methodology, or we first adapted it around 2017, I believe, and we saw the first signal being triggered in real time in the report that we published on the 23rd of August in 2019, that basically nailed the lows of that previous growth cycle to a T. And then last year, we watched as the minor signal was triggered, but then we could also see that there was a major signal building and close to triggering, which finally triggered in September. And those helped to give us even greater confidence that we were seeing the absolute peak of that growth rate cycle and almost the peak of sentiment towards Australian property, at the end of 2021. And obviously both credit and then also prices have deteriorated ever since then. Now, at the moment, we don't have any of these liquidity diamonds or liquidity turning point signals even close to being triggered. So we still are a little way away from even starting to look for what could end up signaling one of the bottoms or the lows of the next trough in growth, or the end of the next slowdown in credit and then also property prices. But we'll be updating that as we go, in the quarters to come. And it is still highly probable that we do get another one of these things trigger, towards the lows of the next sub-cycle in growth. But we just need to monitor and see what happens. Australia is only quite small in the broader scheme of things. That's why analysing capital flows in the world is actually so important to even analysing Australian property markets. And so this is just another example. So this is the US current account balance. So obviously showing a deficit at the moment, but the US current account is one of the best leading indicators of the Australian unemployment rate, which for a variety of reasons makes a fair bit of sense, except for perhaps this anomaly of the COVID-related shutdowns. But basically where you see that current account deficit, which is in effect one of the primary suppliers of demand to the global economic system. And so when the US stops providing demand to the world, by way of a contracting current account deficit, then usually the world starts to stumble. And then we, from Australia's perspective, we start to see these rises in the unemployment rates accordingly. And so now, for the first time in a little while, we've seen a shift in this trend back towards a contracting US current account deficit, which means that there's less demand being provided to the world. And so if history is any guide, this basically means our unemployment rate will start to pressure higher sometime over the next 18 months. So it's a fairly large report, but in a summary sense, what we've just discussed effectively, gives you a little bit of an overview of what is going on. And at the end of the day, we largely see that, barring any other international type negative surprises, leading indicators are suggesting that the current slowdown in Australian property related credit growth and also property prices, and there's usually a bit of a lag of anywhere from 3 to 6 months between where credit growth goes, so mortgage lending versus what then filters through to property prices. So the current slowdown in property-related credit growth should start to bottom sometime in or around the second half of 2023. And so that's our primary view or thesis, or what the leading indicators are tending to suggest. Particularly capital flows are particularly decisive around that sort of a picture and sort of leading relationship. But we just need to continue to update all these different data sets and methodologies and see where things evolve. But we'll be updating these property market publications with all of these leading indicators probably every 3 to 4 months on average, or as conditions dictate. So hopefully you found this helpful. This has been Daniel Want from Prerequisite Capital Management.